Hello everyone, happy Lunar New Year to those who are celebrating. Here's a quick summary of this video's content. US stock market rallied for 3 consecutive Fridays as the strong start to 2023 continues. Netflix and Google led the technology sector in the latest massive rally. Huge earnings week ahead with Microsoft, Tesla, MasterCard etc. reporting their results. Has the tech wreck been pivoted to tech revival? If these topics interest you, do stay tuned to find out more. The US stock market rallied again on Friday for 3 weeks in a row, led by the various technology giants. The tech-heavy Nasdaq closed the day with about 2.7% gain, one of its biggest single-day rally in recent months. It was also the outperformer for the week, as the other major indices remain in the positive territory for the year, for now. This latest rally in the tech sector can be credited to 2 companies, namely Netflix and Alphabet, aka Google. Netflix reported their earnings last Thursday. Their results were mixed, as their subscribers grew more than expected, but their quarterly earnings missed analysts' estimates. However, I guess this was perceived as good news by the market, and Netflix rallied close to 8.5% on Friday. And then we have Google rising more than 5% after the company reported that it will ex 12,000 employees. Again, this is the classic bad news is good news example, where investors cheer on bad news as they believe the company is taking steps to cut costs and be more cost efficient. The week ahead will be a huge week of earnings led by Microsoft, Tesla, Boeing, Visa and MasterCard. These companies' earnings will offer investors some insight of the respective industries. As shared in my previous video, and as seen from Netflix's case, the earnings reported by one giant company in a particular industry can trigger huge moves in other companies in that industry. Anyway, some investors are of the view that money are rotated or transferred from defensive stocks to tech and growth stocks, which probably triggered last Friday's massive rally. Personally, I do believe that tech stocks do have further runway to go up, but that does not mean it has to happen this or next week. This also means that the market can have a huge dump anytime before going up again. Don't forget, we have lots of tech companies lining up to report their earnings these 2 weeks, and the market could move in a huge whipsaw manner based on the various results. I mean, we saw from Netflix earnings that the market can rally hard with a not so bad result. Hence, likewise, if another tech firm reports a poorer than expected result, we could fall big time as well. This week, the December's Core Personal Consumption Expenditures Price Index will be out too, on 27 January Friday. This PCE data is said to be the Federal Reserve's preferred measure of inflation. So if this inflation gauge eases further, investors will be even more hopeful that the Fed can slow the pace of its next interest rate hike to 25 basis points. On the flip side, if the core PCE data somehow goes back up to 5% or more, which is higher than November's 4.7%, we can likely see some blood in the stock market. Now let's move on to the technical analysis segment. As shared in my last video, the stock market rally was due for a pullback, and it got one. SPY reversed sharply on Wednesday with the big fat red candle and then continued to fall on Thursday. Such pullback is always healthy, especially when it has run up quite substantially. If you could also recall from my previous video, there are 3 key levels to watch where SPY is right now, and they are the 200 moving average, the 50 moving average, and a gap that was already filled at 391. For the 2 moving averages, SPY went below both levels earlier on Wednesday and Thursday, but reclaimed both of them on Friday. So what does this mean? To be very honest with you, it means nothing. It just means this is a rough battle zone between the bulls and the bears, and there is no clear winner right now. If anything, bears still have the upper hand. Why? Simply because SPY is still below this red dotted downward trend line. Again, if you could recall, we were rejected by this trend line in the last 4 occasions and got rejected again this time, making it the 5th time. To me, SPY needs to go above this trend line, retrace to test it, bounces to close above 408, then the short-term trend is considered slightly bullish. Anyway, something that bulls can potentially cheer about is that the cup and handle bullish pattern seems to be taking shape. So if SPY can bounce off from this point, or maybe bounce from the support level of 385, then we could potentially break above the trend line and retest the psychological level of 400 and December's high at 408. On the downside, keep an eye on the two moving averages, currently at 392 and 391. If we start closing below them for 2 days or more, then bears are gaining control. But when that happens, I am not too concerned yet. Why so? Check out this mini consolidation zone between around 377 to 385. It should offer some form of support. SPY will truly consider bearish if it starts breaking below this area, as that's where we could unlock more downside towards 370 or even all the way to 355 area. Alright, now let's have a look at Apple's chart. In my last video, when Apple closed at 134.7, I shared that from now till their earnings date, which is 2nd February, we could head towards 140. At the moment, it seems like we are still on track, with Apple gaining about 2.3% last week. Similarly, for this week, watch out for the 50 moving average at 139 as well as the 61.8% of Fibonacci extension level at 140. These two levels should form a heavy resistance. If we break above it, then the next level of resistance will be the top of the downward channel marked by the red dotted lines. So in order for Apple to turn bullish, we need to clear these three levels. Uphill task, huh? Speaking of downward channel, Apple has been trading within this channel since September 2022, and that's about 4 months already. Interestingly, it has been moving in the same manner, such that it got rejected whenever it hit the top of the channel, came back down, retest the bottom area, broke it a little on a few occasions, and went back up again. So based on this observation, I sold a put contract on 9 January, which is a bullish move. But of course with the help of other signals. Just to share with everyone, that period was when Apple was at the bottom of the channel. It basically gave me 3 signals to go bullish. First, it bounced off the bottom trend line. Second, it gave me a big fat green candle. And third, there was a bullish cross on MACD. With all this in place, I assessed that the probability of Apple following the same pattern by moving towards the top of the channel was high, and therefore I opened that trade. So far, the trade has been playing out well. Okay, now let's look at the downside. What goes up must come down. At one point, Apple will start its retracement again. For me, I will keep a lookout for 134 and 130. These two levels should offer some good support if Apple doesn't throw in a very bad earnings report. But if they do, and if 130 is breached, don't be too shocked if we break the 124 and create a new 52-week low. I mean, though not guaranteed, but there is a chance that Apple may just follow its usual pattern of heading towards the bottom of the channel. And when that happens, it will likely go below 124. Moving over to Tesla, the company will be reporting their earnings report on 25th January, Wednesday, where investors can expect huge movement on that day, like more than 5% that kind. Speaking of huge movement, if you haven't realized, Tesla has gone on a massive rally from 101 to 133, and that's about 31% rally. If you had followed my previous videos, you would have known that I quoted Meta, Nvidia and Netflix as examples where a strong company gets capitulated, the rebound usually is quite substantial. But still, kudos to you if you have managed to ride this uptrend. Personally, I did by selling put contracts, and so far they are profiting now. Anyway, I previously shared that Tesla has room to go, and it may go as high as 140s or even hit 150. Currently, it is still on track, but with a huge caveat, and that is none other than the earnings. We really don't know how good or bad the results would be with the recent price cuts worldwide, demand issue, and a possible lower profit margin. If it turns out to be not so bad, then forget about the Fibonacci level of 138. Let's go straight to 150 and 155, where the 50% Fibonacci extension level and 50 moving average are respectively. 155 would be a heavier resistance in my opinion. As we all know, Tesla is capable of parabolic move, and if it does a Netflix on Wednesday where it gap up and charge towards 150's range, I don't know about you man, but I will be very cautious because as they say, 90% of the gaps get filled eventually. Therefore, bears, not financial advice, but you can consider going bearish when that happens. On the other hand, if Tesla gives us some shocking results, the slide down could be massive. The first support is at around 120 to 124 range. If this doesn't hold, we could once again enter this consolidation zone that ranges from 90 to 120. When that happens, my earlier comment on Tesla having the probability of hitting 90 seems to be in play again. But before that, 100 should offer some form of psychological support. Last but not the least, thought to highlight something to everyone. It looks like a gigantic bear flag is forming, a flag that stretches from early December till now. This is a very similar setup to the one we had during September to November period. Again, earnings will be crucial. If market doesn't like it, I think the chance of us falling below 100 is high with the breaking down of a bear flag. Okay, since Microsoft is reporting their earnings this week, I have decided to cover it. The stock is currently approaching resistance level at around 243. A good earnings from the company should push the stock higher towards the 200 moving average at 255. Coincidentally, that is also where the red dotted downward trend line is. This trend line stretches all the way to November 2022, where Microsoft reached its peak. Therefore, I am expecting quite a heavy resistance at this level. On the other hand, bad results could see us get rejected at the current level and head towards the bottom blue dotted line. A break below the blue dotted line will get me excited, as that is the consolidation zone that I have been waiting to load up more shares. The zone ranges from around 200 to 220. Lastly, let's talk about Google. Google had a massive Friday last week as the stock rose by more than 5%. I am a long-term investor of Google, but as a bull, what I don't like to see is a parabolic gap up. Given the current weak market, it is highly likely that this gap gets filled sooner rather than later. As a result, I sold a covered call contract on Friday, which is a bearish move. Anyway, Google will be hitting resistance at around 100. This is a level where it has not been able to cross since mid-November 2022. As you can see, it tested this level on a few occasions and got rejected each and every time. But let's say if this time round is different, if Google breaks above 100, then we will likely fill the gap at the top at around 102. That is the reason why I sold my call contract with 103 strike price, as I am in a way protected by two resistance levels. As long as Google does not close above 103 by the expiration date, my trade will profit. The super heavy resistance should come at around 105. I guess at this point it's about which gap will get filled first, the top or the bottom one. Alright, here are my end thoughts. There may be investors who believe that the tech wreck has been pivoted to tech revival or tech rally. Money are flowing into the various very beaten down tech stocks. Some reasons behind this could be investors are expecting a possible soft landing or at max a mild recession. Furthermore, Netflix gave us a not so bad earnings result. To add on, you have big tech players cutting jobs, saving costs, etc. Therefore, the market is getting hopeful once again. My personal view is that I think the next 2 weeks will be critical as the earnings reports are tech heavy. It will give us the chance to assess if the tech rally can indeed continue. Meantime, I would also like to take this opportunity to caution everyone that earnings season can be the catalyst for both big market gains and losses. Another thing to highlight, by now we should be aware that most of recent bad news have been perceived as good news for the stock market. But my view is that the stock market cannot keep going up on bad news. Bad news such as weaker earnings and guidance from various major US companies may continue to apply downward pressure on the US stock market. To add on, yes, inflation number has cooled, but then it's still quite high. At one point, inflation may get stubborn and sticky again, where Fed might find it more and more difficult to push it lower. Slowing economy and the recession that everyone has been calling could continue to cause negative impact to the stock market. Though some may say that the market has priced that in already. But who truly knows what has been priced in? The point here is better to be safe than sorry. And one day bad news will really be bad news for the stock market. It may not be good news anymore. Technical wise, the stock market, at least for S&P 500, is sitting at critical levels as shared in the technical analysis segment. This means it can go either way, and therefore I don't think it's wise now to get all excited about the rally and start pouring all your money in. Likewise, one shouldn't remain bearish throughout if there are signs that the rally is going to continue. That being said, my view is that the trend is still leaning towards the bearish side. Long story short, we need more indices, big companies to reclaim their 50 and 200 moving averages, and also for these two moving averages to start curling upwards, and ideally to form a golden cross. Okay, if you don't get this portion without looking at charts, it's fine, just continue to watch my videos as I provide weekly updates for you with simplified technical analysis. Okay, that's all for this video. Are you turning bullish now? Let me know in the comment section below. Lastly, please do remember to hit the like and subscribe buttons if you haven't. Thank you.